All right, Ken, thank you very much, Amira. Okay, so good morning, everyone. I hope you all have your breakfast. All right, a good breakfast. Okay, so today our masterclass is actually financial modeling and valuations. I think the main focus is actually more towards focus in the financial modeling. All right. So then, yeah, I think Amira already highlight about my background. So I'm from Finbiz consultancy. So based on my previous job position or even like current, right? So I'm actually a CFO of a listed company. Before that, Stansoft Holdings. Even right now, right, I'm also the CFO, for the submission for the IPO. Okay, in the same times, I'm also doing some fundraising exercise. I'm actually the one who actually assists in terms of more towards the financial part. All right. So next one. All right. So I hope that I can expect some of the response. I mean, of course, I mean, if you are really too shy, sometimes you also can do some the chatting or type writing, for the response. All right. Okay. So first, I just want to ask, right? In terms of some of you is actually set up the companies, right? Or maybe some is actually already have about 2 years, 3 years, or even 4 years. This how to say after the startup. Okay, so can I just ask every one of you, right? Actually, how much your company worth? So is anyone can reply to me how to determine the worth of your company? Yeah. Is there anyone or even like do some typewriting or what? Yeah. Is there anyone? No. Okay, I saw a chat.
Hi,
Yeah,
can you hear me?
Yep.
yeah, I can. Yes.
Hi, I'm Humayun. I'm from Ogya Mobility. So it's a e-scooter company.
Yeah. Good morning.
So,
Yeah.
good morning.
Yeah.
Thanks for the.
Sorry, I think, hi, Raza, I think your line is breaking up.
Uh,
Your line is breaking up.
can you hear
I
me
can hear you,
now?
but your line is breaking up.
Can you
Yeah.
hear me?
Yeah. Yes, can. Maybe you can turn off your camera, maybe. Because the
You
line
can you
is
can turn off your camera. Yeah.
Yeah, yeah.
Okay. Yeah.
awesome.
Yeah.
Is it any better now?
Yes.
Yep. Okay. I think we lost you again. Yeah,
Uh,
I can't hear you, Razak. Yeah. Or you can do some chatting. You can type something in the chat box. I can take a
yeah.
look as well. It's okay, no problem. You can just yeah, a short the typewriting in the chat box. Yeah. Okay. Yes, you are doing the fundraising. Yes, it's a hot topic. So okay, you are currently valued at 5 million. Okay, my question is how you plug the 5 million. Okay, so there's a five revenue multiple. Okay, yes, partially you are right. You can take about your revenue, but my question is, your revenue is a current revenue that you already earn or your future revenue. Okay, current revenue. Okay, okay, that is good. Okay, then can I know that how much in terms of your profit you can put a profit before tax, no issue, or even net profit is fine. How much your estimate profit? Do you have a profit? Okay, No problem. So fine. So because you see, some of the investor, right? Yes, I mean, of course, they look at revenue, but some they also look at the profit as well. Okay, so today, the session, right, that we were actually going for quite details of the financial modeling. That's how derive the revenue and profit, all these things. And also the second thing is that I also will share in terms of how we actually determines the valuation, especially those startup. All right. Okay. So I move to the next part. Okay. So you see, just like I mentioned, right, how much your company worth. All right. So if you all can look at the picture, right, the left hand side is a fried chicken. The middle one is also a fried chicken, and the right hand side is also doing a fried chicken. But do you know these three shop, right, basically have a very huge different valuations. All right. So again, I think if you look at the left hand side, right, it's actually just a store. All right. So again, how much the valuation you can raise if you just are having the fried chicken in a store. Okay. And then in the middle, right, it's called a hot bird. I'm not sure whether you're aware which shop is this, but I think recently they have two branch. One I think is the Uptown, is quite famous, and this is they're also doing the fried chicken, with some secret recipe and all these things. So basically you can also refer to as a startup. Okay. And then the third one, I think McDonald, I don't need to intro anything because everyone is a very huge corporate entity, which their valuation is far more behind, than just a normal fried chicken selling price. Okay. So this is actually the interesting part. You can actually selling the same thing, but in fact, in terms of the valuation, it can be so differently. So this is actually, I just want to share with you what is means of the valuations. All right. Okay, so the next, what is valuation? Okay, valuation is actually an analytical process of determining the current or projected worth of an asset or a company's. All right. So of course, in terms of the methodology, there is too many methodology. You have a market value valuation, you have an asset-based valuation, you have a ROI-based valuation, you have a discounted cash flow valuation, and of course, you have a multiple of earnings valuations, and also you have a book value valuation. All right. So if let's say if come to the more towards in terms of the startup companies, right? So normally people will look at the discounted cash flow valuation because you need to do a forecast of your cash flow, and then based on the next let's say 3 to 5 years, right? You may need to have some discounted. Then that it will be the way that you have the discounted cash flow valuations. All right. Okay, so how important of a valuation for the startup? All right. Okay, so if you look at the chart, all right. So from your pre-seed round, and then you go to the seed round, and then you go to the series round if you have A, or if you have A, B, or C, or even D. Okay, and also final, let's say you want to go for the IPO. All right. So your equity interest is actually keep diluted from time to time because you're actually having the pre-seed round, you're having the seed round, you're having the series round, or even you go to the IPO, right? You were going even raise more funds, and also maybe perhaps you will offer for sales of some of your own equity interest. All right. But even though your equity interest is keep diluted, right? But if you look at the valuation, it's supposedly to keep higher and higher because each round of the funds, right, you should have some achievement of KPI to going to meet. I mean, of course, IPO, if you want to go for the main market, so minimum is 3 years, you must have a cumulative net profit of 20 million. All right, so there's some terms and criteria for the IPO. Okay, I mean, what I mentioned is more towards for Malaysia. All right. So this is basically, I just want to share with you valuations. What is the valuation, and also some general guides in terms of the valuation. Because after this one, I will go for in terms of the financial modeling. Because before you go to the valuations, right, the most important step is actually the financial modeling. Okay, so the first introduction that I want to share to you all is the key learning outcome for these sessions. Okay, is first, I mean, we have to know what is actually our objective. Okay, so we need to understand the importance of financial modeling and also how to value companies and also plan a fundraising roadmap and also, of course, prepare a cap table based on your business model. All right. So all these area will be covered the cost of this masterclass. Okay. So okay. So now we actually will discuss about the importance of the financial planning and also how to execute. All right. So okay. So you look at the left hand side, right? So ideas and visions, and then a lot of strategies, because I understand each of the entrepreneur, they have a lot of strategies they want to go for. Sometimes it can be go for marketing, sometimes it can go for production, some is can go for the even like sales, and some even can go recruit a more consultant or more people to actually run the business. All right. And then the third one is the funds to expand the business. So basically the left hand side is a very clear idea, visions, ton of strategies, funds to expand the business. I think it's a very general facts or statement, from an entrepreneur. Okay, but if you look at the right hand side, so this is actually how we look at the financial modeling. So if you look at the ideas and vision, right, sometimes from our financial person, we were actually asking whether this kind of ideas and vision, right, will it be a sustainable operating business or not, or it's just a short trend. It's just about 1 year. Then after that, it's gone. Means it's gone. So this is actually how we look at in the financial modeling, because financial modeling, right, easily you need to build a minimum 3 years or even to 5 years. It's a 3 to 5 years thing for the financial modeling. All right. So then the second, a ton of strategies. Our question is whether is that makes sense or not, whether you can match to each other strategies or not. Okay, some people will say, okay, I want to do a sales, for 10 million, for 20 million. But somehow, if you not recruit any person, right, or marketing person, right, how can you achieve that revenue? Or maybe it will turn around. If I want to achieve the sales and revenue, right, maybe I need to have incur this kind of marketing expenses. But again, is that really related? That marketing you spend, definitely you can generate the revenue or not. So all this we have to look at whether is that makes sense or not. All right. And also some even like from a manufacturing companies, right? For example, they want to say they want to achieve the sales, for that much, how many quantities. But again, whether your production line is ready or not, whether your whole line production is whether is in order or not. Then how about in terms of the repair, upkeep, overhaul? Have we actually considered about that part or not? Or okay, and then of course the last one, the funds to expand business. I think it's a very generous statement that everyone want to expand the business, but the problem is where is your breakdown, and then whether each of the funds that you utilize, right, is that reasonable or not? Is that worth that what you're spending or not? So this is actually the reason for financial modeling, because it can actually give you more details from the top line revenue and come all the way to the bottom line. All right. And also it's actually also determined in terms of timing, and also because it's actually a long term, it's a 3 to 5 years. It's not just about one thing that you think is a good idea, then you just execute accordingly. All right. Okay, so in terms of the startup business, right, they actually have two approaches of the financial modeling. Okay. Okay, one is actually the top-down forecasting. All right. So if you're using the top-down forecasting approach, we can work from a macro outside-in perspective towards the micro view. So industry business information typically shall be early benchmarking point and step-by-step narrow down into the target that fit the company vision and strategy. All right. So this top-down forecasting, we normally call it Samsung model. All right. Okay. So what is that means? All right. For example, the top-down forecasting, right, is you have to look at the macro view first. For example, if you are actually selling, let's say selling the ice cream, all right. So first of all, where you want to target for example, maybe I want to target for Selangor first, all right. Then subsequently, I only will go to this Johor, or maybe after that I will go for the Kelantan, or maybe subsequently I need to go for Kedah. All right. So you look at the population at that state, and also maybe you also, if let's say you have information that for ice cream, how many they're selling, in terms of your competitors selling. So you're actually looking more towards in terms of macro, and then slowly zoom in to the serviceable, obtainable market, which the percentage of market that you can realistically capture. So this is more towards forecast from the top-down forecasting. All right. So with this 10 Samsung model, right? So the next step would be estimated all costs needed to build to deliver your product or services. Because once you actually have your selling quantities, right? So of course you can determine your pricing on this thing. Then the next thing you need to estimate your cost. All right, what is your direct cost to build or deliver your product or services? All right, and then after that, the next thing is the expenses needed to perform the business task. For example, maybe marketing team, sales team, R&D team, or admin team, or finance team. All right, and then the next one is the reasonable time frame on the deliverable. For example, if you want to set up a manufacturing or production, right? For example, maybe initially you just take about 6 months, you can complete the production line, but somehow when it's, let's say it delayed, from 6 months to 1 year, right? The whole funding that you require, right? Definitely, totally, it will be a different, because each time you delay, right? Then that means you have to incur more money into your startup business. All right. So the time frame is also very key and also important to critical when you actually forecast when you're doing your financial modeling. All right. So the first thing, what you need to do is actually you must have a positive cash flow. So what I mean the cash flow, right? It can be a fundraising, or it can be a borrowing, some of the borrowing from a relative, or from parents, or from good best friend, Then the second step, it should sustain the business. You must sustain the business. All right. Then after that, then you only will try to actually achieve this positive EBITDA. Then that will be achieve your goal. Okay. So ultimate aim for this 10 Samsung is we need to ensure the revenue exceed all the costs and also expenses to get a positive EBITDA, and also the funds that we raise, right, must be able to sustain the business and generate the positive cash flow in stipulated time frame. All right. So if you do not have a sufficient cash flow, perhaps in the middle of the, maybe let's say for example you want a 6 month, right? So maybe let's say 6 months you're unable to finish your production. Maybe the 8 month, 9th month, right, you cannot continue anymore because you basically do not have funds to run accordingly. If you do not have funds, how are you going to pay the salary for the staff, and how they actually help you to set up in terms of your production? So all this time frame is actually very critical when you want to do the financial modeling, for this for your business or your startup business. Okay.
Right,
Okay.
Ivan. So sorry,
Yeah.
before you continue, I think Anna has a question. So she wants to understand how to calculate SOM better.
Sorry. How to
calculate SOM better, times and SOM.
Oh,
So how to do
oh,
some calculation? So her question, if we take 10% of market, but investor usually want to know why 10%, why not 8%, why not 12%? So can you help them to answer this kind of question?
okay. This question, right, will actually continue my next approach. So I think
Okay.
maybe I will answer together after I finish the next slide. Is that all right? Okay.
Yes.
Okay. Okay, so in terms of the next approach, right, we call it a bottom-up forecasting. Okay, if you're using a bottom-up forecasting approach, right, it is actually less dependent on the external factor, but leverages internal company-specific data, such as, for example, your historical sales data, or maybe your company internal capacity or resources, human resources. So this means the projection is made based on the main value driver of the business. All right. So the pitfall of the top-down approach, right, it may be seduce you to forecast too optimistically, especially sales. All right. Sorry. Okay, if let's say you are a startup founder and looking for fundraising, right? So the bottom-up approach, right, might not do the trick. Okay, because your historical data may be too not really good because you just start up. So investor usually expect startup to grow fast and also gain the significant market share rapidly. Okay, so what is actually the recommendation for the startup business? So we basically will be using a combination of the two methodology. All right. So first, you must use the bottom up for the short term, because you see, before you start the fundraising, right, you definitely have to do some forecast. I mean, of course, you have to really go for max, whatever that your internal capacity you have, you should put to the max. All right. So then after that, once your fundraising is coming in, right, then you can use the top down for the medium and also longer term. All right. So this can actually help you to sustain the business and also can defend the short-term target. Because for example, if you mention about 6 months, you generate, million and million. But somehow after 6 months, the investor say, hey, come, can I see your 6 month performance before I pump in the fundraising? You only can do a 100,000. So million as compared to 100,000, right, is actually quite a lot. All right. So, and then also the next thing is the long-term target, right, to demonstrate the desired market shares, right, and also match with the aim of investor is looking for. So perhaps as an entrepreneur or the one that you want to do the fundraising, you all should know what is the aim of your investor is looking for. Okay, so I come back to the earlier question. So how much in terms of the quantity, right? So this is what I mentioned. So first of all, you can use the bottom up first for your short term. Then subsequently, right, in terms of the market share, right, in terms of 10%, 12%, right, then you have to think, if let's say you really want to have a 10%, 12% to achieve this quantity, right, how many people do you really need, to hire, or maybe how much of the marketing expenses that you need to spend in terms of the acquire that kind of market share. So the calculation will not be just like 10%, 12%, but you look at the quantity, and also the second things based on the sales quantity that you're going for, right? What is actually the expenses that you need? Do you need a very lean a person to help you to deliver that? Can you really push everyone, to motivate every salesperson, right, to derive that figure or not? So this is the entrepreneur, what they need to do. What you all need to do, okay, is your own strategy. Because I can tell you, because for me, right, if you're asking me, right, one person can help me to generate the 50,000 revenue. But if I'm good enough, right, I want one staff, right, I can even generate 80,000 revenue, per day or per month. All right. So this is actually how an entrepreneur to put their own strategy in. All right. So as I mentioned, in terms of the put 10%, 12%, you can put, but you need to justify with your own business model, and of course together with this one, right, bottom up forecasting and also top down forecasting, right, this and actually can explain, to the investor. All right, I hope I answer your questions. Yeah. By the way, Amira, you will look at the question, right, because I will carry on with the condition. All right. Okay.
Yes.
Yeah. Okay, thank you. Yeah. Okay, so again, everyone is talking about financial modeling. Okay, actually, the keywords of the financial modeling is very simple. We call it assumptions. All right. So assumption. Okay, how actually making a very good assumption. Okay, so when building your financial model, your number will be crucially substantiated by the assumption. Okay, with a historical data often available, projections and future estimated returns need to be backed up by a proof. Okay, let me to inform you all, because everyone say, financial modeling is just you just plug from sky, then you can just do the financial modeling. Actually, from my perspective, it's actually not. I mean, even like I myself, last time I'm a reporting accountant, even you want the submission for your IPO, all these things, right? You have to do a forecast and projection, and all the forecast and projection, right, should have a basis about, yes, I mean, it's a future event, but you still have to back up with some of the proof. Okay, maybe I will try to share very simple things, right? For example, like audit fees. Okay, how much you have to estimate audit fees. All right, so basically you can actually get a quotation from someone else, or if, for example, even you want to do a manufacturing, you say you want to do this kind of sales and revenue, right? Then which kind of the machine that you need to buy, whether is it the whole things, all these things. So all these things, right, can basically actually asking for the quotation. You can even get a 3 quotation for that as well. So this is what I meant for, some of the proof that how much capex that you need to spend. All right. So also, for example, like some of the marketing expenses, right? All these data, right, is already can be available. Whether some of it you can go, Google search, or some of you can get quotation, or some of it, right, you can get, some of the price information, from this consultant or third party professionals, expert. All right. So again, assumption can be gleaned from a number of sources. So as I say, market research, web search volume, supplier contract, pricing validation, historical sales data, conversion rate or website traffic. So all these things is actually kind of a proof. All right. So even though I think I did a one online travel agents forecast and projection as well. So all the traffic, how many person is traveling, from one country to another country, all the data is actually available in the internet. So so what I mean is like it's very difficult to say that you cannot get all these futures transaction or information to do your financial modeling. All right. So again, for the startup, right? I think mostly people will say the people will not look at the financial modeling in so details and all these things. But again, always anticipate that investor might request for due diligence process. Yes, it's not everyone will do that. But again, yes, I've seen some is they really want to do the due diligence process for your financial modeling. So again, have a place with all this information collected so it's easily accessible, and also make the process of the validating or proving your assumption is much more realistic. It's not just simply, the revenue 10 million, just fill the 10 million, into your financial modeling and can get your valuations. All right. Okay, I move to the next. Okay, so the outcome of the financial models is actually rely on a few crucial metric key to the success of a business. All right. Okay, so I believe everyone know what is a P&L. This is just an illustrative. I think you don't need to look at so detailed. You just look at in terms of the presentations of a P&L. All right, because I will go more in details in the slide later. All right. So then the next thing, of course, cash flow. You have your 12-month cash flow. Again, this is also a simple template, for the cash flow. All right. Okay. Now I have another questions. Okay. So can everyone share with me, right? What is actually difference between P&L and also cash flow? Can anyone share with me? Because you see revenue, you can have it in your P&L, but somehow in terms of revenue, right, then you also have in the cash flow, your cash inflow. So actually, what is the difference between a P&L and also cash flow? Can anyone share with me? If you are too shy to speak out or voice up, you can type into your chat box as well. Anyone? Anyone know what is the difference between the P&L and cash flow?
Hello, can you hear me?
Yeah,
Yeah,
yeah.
Yeah, sir. I think P&L includes the depreciation and all those things, a lot of other factors inside, and cash flows is actually about like the current cash flow, like current cash the company actually has. The P&L includes all other parameters. In P&L includes other parameters as well, I think.
Okay, understand. So when you talk about the depreciation,
In
right?
the
So I
calculation.
normally refer to the fixed asset, right? Fixed asset. So the fixed asset,
Yeah.
supposedly when you buy the fixed asset, right, you also have the money to pay off, right? So it will appear in your cash outflow.
Okay.
Yeah. But
No,
anyway,
I'm just saying. I'm just
you
saying.
are
Yeah.
partially correct, but you still not complete the phase.
Oh, okay. Okay.
Yeah. You want to try again? Yeah.
I just know the rough picture of it only. So yeah, probably you can explain more about it.
All right. All right. Can no problem. Thank you very much, Ashwin. Yeah.
Sure, sure, sure.
Yeah. Thank you very much. So I think others no reply. Okay. then I will just proceed accordingly. Okay. All right. So basically, the difference between the P&L and cash flow, right? I think the key point for this one, right, is only one, which is the timing. All right. So timing is always the difference between the P&L and cash flow. For example, if let's say today you deliver the products, or services to your customer, right? You actually can recognize in your revenue in the current months. Okay. But somehow, in terms of your collection of the revenue, right? Normally, it may be 60 days credit terms, or maybe like sometimes, it's even worse, or 90 days or 120 is, that depends on how good, in terms of the business. All right. So that is actually the difference between the P&L and cash flow. All right. So timing is actually the key point. Okay. So yeah. So, okay, yeah, I just read through this paragraph. Cash flow is the money that flow in and out of your business throughout a given period. All right. While profits is whatever remain from your revenue after costs are deducted. So, we'll show you the immediate success of your business. Okay. And yeah, so this is actually the difference. As I say, these two metrics, right? The key difference is actually the time. All right. So, and then the next question is the cash flow more important than profit or not? I mean, as a startup business. Okay. So the reply here is ultimately cash flow and also the net profit measure different things. Okay. While profits is the goal and also the indicator of the financial health, and cash flow is the lifeblood of an organization to keeping the operations taking over on a day-to-day basis. For a growing business, right, both cash flow and net profit are important, but in the short term, cash flow is more properly the number one concern. Because as I mentioned earlier, for example, if cash flow for me always I refer as a blood. All right. If your blood is not circulate, to whole of your body, right? Perhaps your hand may not be function. Your leg may not be function. Your brain may not be function. So it's the same thing. If you do not pay some cash, right, to the staff, who can actually help you to do the production, to help you to move the thing here and there. So that is what I'm referring. So in terms of the startup business, I believe cash flow is the more important than. But somehow, if you are more become like stable and all this thing, right? Yes, I think profits is also important, because even though you want to go for the loan, even like fundraising through debt or also through equity, right? They need to look at your profit, even IPO. That the key indicator is also the profit. All right. So this is actually the key components between the profit and also the cash flow. All right. So far, any question from everyone? Is there any questions?
Any questions, guys? If no questions, you can do thumbs up if you want Ivan to proceed.
Yeah. Thumbs up also can. Type
Okay,
in
all
the chat
good.
also can. Yeah.
I think they're all good, Ivan.
All good, all right.
All good.
So no
Semua
question.
thumbs up. No
Okay.
question.
Good. Okay. As long as I understand. All right. Okay, then I will move to the next. All right. So this is another part. Is we call it a KPI overview. Okay. So what is actually KPI? KPI is a key performance indicator. So it's actually quite an important tool for the investor and founder. So it's actually can allowing you to track the company performance and also experiment with a different acquisition channels, business model, and cost structure. All right. So again, when you're doing all the financial modeling, right? So basically, you can, if you can doing the P&L, definitely you can do the cash flow as well. And of course, if you have these two items, right, balance sheet also can form easily. All right. So once you have all these components, right, then you actually can set up the KPI. So, and all these KPI, right, is very useful in ensuring that the founders, right, are able to set a realistic and also quantifiable and relevant target based on their business, and also can reliably work on achieving the best result. All right. So, for example, sometime, right? I think even though investor may not as experienced like the entrepreneur or even in the groundwork, but they do have a very how to say a focus in terms of some of the KPI. For example, if you have the business in a specific industry, right? Normally they know what is actually your gross profit margin. All right. So for example, if you're doing this F&B, right? I mean, basically the margin is, let's say, about range about 30 to 40%. But somehow your financial modeling, you can do it like 70%, 80%. So perhaps they can actually raise this question to you and asking you, how come you able to do this 70, 80% GP margin? So is your financial modeling is realistic or not? Is your valuation is valid or not? So all these things is actually, we call it a KPI. So the investor may actually raise up some of the queries in terms of the KPI. So what are actually the KPI? Actually, the KPI cover quite a wide range of the metric. So it's including the industry specific metric, for example, the customer lifetime value, customer acquisition cost, churn rate. All right. The next one, cash flow and raising investment, burn rate, runway, and also your liquidity ratio. So all these runway, other new startup maybe is using about 1 year. Somehow your runway is actually using a 3 year. So most probably they were asking how come your runway is so long. So this is actually one of the key KPI for the investor. And of course, the next one is the sales profitability performance. So of course, you have a revenue growth rate, you have a gross margin, you have your EBITDA margin, you have a profit. All right. So all this is actually the KPI overview. All right. Okay. So in terms of the financial modeling, so we have a few elements, in terms of this financial modeling. All right. So so basically, the first one is actually what is the revenue? So revenue is the value of all sales of goods and services recognized by a company in a period. So revenue also referred to as a sales or income forms the beginning of a company's income statement and is often considered the top line of a business. So expenses are deducted from a company revenue to arrive at this profit or net income. Okay. So the key takeaways for the revenues, right? Normally you have to list down your product and services, how many product you have, how many services you have. All right. And then again, second, I'm always mention the top down. You also extract the industry, your industry and market shares. All right. And then in terms of the bottoms up, is you using a unit price and quantity to determine your revenue, because a unit price times quantity, you will get your revenue. All right. So these few things is a very key part that help you to calculate or to do the forecast and projection on your revenue. All right. So again, revenue recognition principle, right, is according to the revenue recognition principle in accounting, revenue is actually recorded when the benefit and risk of ownership have transferred from seller to buyer, or when the delivery of services has been completed. Okay. So actually revenue is perhaps many people will think the revenue is a very straightforward thing, but actually in the accounting, revenue can be a very complicated thing, in terms of the accounting recognition. For example, like property developer, I believe here got no one doing a property developer or construction, but the revenue is totally different. You cannot say, you send a building to the buyers, right? Then you can actually recognize the revenue. No, there's a called percentage of completion to calculate the revenue. All right. So maybe here I would like to ask, I think even I just now, there's one participant to mention that they have about 1 million revenue right now, but somehow there's no any profit. All right. Can I know what is the reason that having a zero profit, even though the revenue can achieve 1 million? Just now, who's that? Razak, yeah. Razak, are you still here? Do you mind to share any reason with the revenue 1 million? Okay, okay, I saw. Okay, all right. Oh wow, this is a very good thing. Revenue sharing with the partner. Okay, so who is your partner? Because as I know, right, is it a collaboration agreement for the sharing the revenue, or actually they are the equity holder? Is your partner is the equity holder or actually the a vendor, some sort of vendor to share the revenue? All right. So if that's the case, right? So we call it more towards a cooperation partner, right? Yeah. So again, if you can do it something like a joint venture or equity, right? So perhaps you can actually retain your profit, and then perhaps you can do even like a better valuation for your for your financial modeling. I mean, of course, this is only a suggestion because I may not fully understand what is actually your business. So yeah, and okay, thank you for sharing for this, Raza. And also, anyone is want to clarify in terms of the revenue part? Okay, if you don't share the revenue, yeah, that's why I say maybe again it's a business model. So as I mentioned, of course, I really don't understand your business, but if let's say I can try to structure the business right with the equity, then the profit can be retained. So then subsequently, right, even though subsequently you declare the dividends, right, it's only can flood into the retained earning, but it will not show into the P&L. So perhaps if you're asking me that I will actually try to structure this way, because it is actually favorable for my fundraising exercise, or even let's say if I need to go for the IPO and all these things. Or again, this is my suggestion. I don't know your business. Maybe you are right as well, but this is only my sharing of my experience. All right, Razak? Yeah. Yeah. How about any other ones else? I mean, because even like IT, right? IT also sometimes in terms of you have a project, some is a subscription based. So do you all have any queries that you want to raise in terms of the revenue part? Okay, maybe I can share something in terms of revenue, for example, like the subscription. All right. So based on the new accounting standard, right? Even the subscription that you receive, right? For example, you can receive for the whole 1 year. All right. But in terms of the recognition, right, it has to be divided by 12 months because the services that you provided, right, supposedly is a cover 12 months, but it's not like the 1 year. So maybe this is another key things that I can highlight to every one of you. The revenue only can recognize based on each 12 month. You cannot just put all your whole year's subscription right into that particular 1 month revenue. All right, so this is also maybe one of my sharing in terms of the revenue recognition for the subscription. All right, so is anyone else want me to clarify in terms of the revenue? Because as I mentioned, revenue may be look straightforward, but from the accounting perspective, right, is always complicated. Yeah, or maybe your business is straightforward. Okay, so if yeah. Okay, yeah, Rasa, I think yes, yeah, correct. This business model, yes, is a thing. Yeah, correct. So again, as I say, you can do some structure, then to favorable to your fundraising. All right. Okay. Yeah. Anyone else? If no, then I will move to the next. All right. Okay, I will move to the next. All right, so the next one is actually the direct cost of sales. Okay, direct cost of sales. more commonly known as the cost of goods sold, and also is the amount of cash that a company invests in the production of a good or service itself. Okay, it's also cover the direct labor cost. Okay, and also some utility costs directly related to a production. For example, some of the manufacturing, right, they actually need to consume quite huge amount of the electricity, and that electricity, right, is really more towards for the production or manufacturing of the inventory. All right, so all these utility costs, right, it will not part under the normal admin and operation, but perhaps to the cost of goods sold. All right, and some of the shipping costs, some of the processing costs, and also even like intangible asset. Okay, for example, some of the IT companies, right, they have some of the development expenditure in terms of the IT, because IT is sometimes it's not physical. You cannot just touch it, but it's actually more towards like intangible. You can't touch it. All right. So whatever you incur for that, you will actually capitalize into the balance sheet as an asset, and then subsequently, right, it will be like a fixed asset. It will slowly amortize and then into the P&L. All right. So when you amortize into the P&L, right, so normally that will try to classify under the cost of goods sold. Because why is done so? Because some of the intangible asset, right, is helping the company to generate the revenue from the customer. For example, after you success to develop this IT software, right, you actually selling this software maybe through a subscription model or selling the OEM, So all this will actually bring the economic benefit to the company. And if this is the case, right, so normally the amortization of the intangible asset, right, will also go to the P&L, cost of goods sold. All right. So this is actually some of the example of the direct cost of sales. All right. So what is actually the key takeaway? Again, just now we mentioned you have the quantity in the revenue. So now, if you let's say selling the product and all these things, right, you also have to match the quantity in terms of revenue. You cannot to mention that your revenue is 1,000 quantity, but your cost is only 100 quantity. So it will be a mismatch already. So this is the way that you have to try to match the quantity in the revenue. And also the second thing is those costs are direct associated costs to the revenue. As I mentioned earlier, like even like some of the electricity, if let's say the cost is actually direct associated to the revenue, you have to classify under to this cost of goods sold. All right. And also the third one, manpower and HR resources. So of course, if you are just a finance person, HR function, of course, all these things you can classify as admin. But somehow, if you have a labor, you have a labor to manufacturing, or even you have a labor to help you to do the construction, all these things, the manpower and also some of the HR resources, you have to classify under this cost of goods sold. Okay, even IT, some of the IT person, right, they do have a support team. So that means if you have any technical, the bugs, you have to do the enhancement, all these things, right? So everything is under the support team, IT support team. So all these IT support team which are ever actually helping the customer, all these things is a manpower. You have to put it into the direct cost of sales. All right. So all this is actually the PP&L direct cost of sales components. All right. And then of course, the last one is actually the cost price. So cost price, you maybe can have a unit cost, and even some of the cost price, right, you can actually backward calculation from the GP margin. For example, in your industry, as I mentioned, your GP is like 30 to 40%. It's a rough GP margin. So if you already determines your revenue and selling price, right, so perhaps sometimes you can using a backward calculation from the GP. But again, it depends on a case by case basis. All right. So this is actually the key takeaways for the direct cost of sales. All right. Okay. I saw a question: Is a marketing cost also included in the cost of goods sold? Okay. My question is no. It's a separate cost. It's under after the GP margin. So we call it a marketing cost, selling and marketing cost. So it's not under the direct cost of goods sold, because otherwise, right, it will impact to your GP margin. Okay. Any question? Okay, if no other questions, I will move to next. All right, so now I will explain in terms of the indirect operating expenses. Okay, so what I means of the indirect operating expenses, which means all this is after the GP margin. Again, as I mentioned, GP margin is always important for every business. All right, so no matter from the tax perspective or sometimes even you go for the loan, right, they really look at your GP margin. All right, so that's the things that I'm highlight to everyone. And this indirect operating expenses is the after GP margin. So basically, indirect operating expenses, right, are the costs used by a multiple activities and which cannot therefore be assigned to specific cost object. All right. So instead, indirect costs are needed to operate the business as a whole. Okay. Maybe I will give one example. I think even like some of the company that have about 20 or 30% staff workforce in the company, right? They normally will actually hire a HR person. All right. So a human resource person, right? So basically, he or she will actually doing all the HR work, for the whole company. But again, this HR cost that what he or she doing, right? So it's actually not directly contribute to the revenue of the companies. All right. So if this is the case, right, normally this HR portion, right, will classify under this indirect operating expenses. Okay, and same for the finance department as well. So finance also doing all the finance account, right, as a whole. I mean, they were not saying they're just doing a small part of it. So they were also doing as a whole. So if that's the case, right, so normally we will classify under this indirect operating expenses. Okay, so and also the second key point is normally the indirect costs, right, do not vary substantially within a certain production volume or other indicator of the activity, and so are considered to be fixed costs. Again, if your company, right, let's say for 30%, you have increased the headcount to 35%, right? So it will not means that the one HR person cannot be handle the 35 the workforce strength in the company. Okay, but of course, if your company is having a 30% suddenly expand, to the 2-3 outlet, with a 300%, right? Then of course we need a more HR person. But again, this HR person is more towards in terms of helping, in terms of maybe complicators or even a workload basis. That's the recruitment of the new HR person. But even not because of that, right? Of the production volume, then it will consider a change for this indirect cost. Okay, so the sum of the example of the indirect costs, right, are the accounting and also legal expenses, administrative salary, office expenses, rent, security expenses, telephone expenses, and also utilities. But again, please take note the utility that I mentioned here is more towards the office utility. It's not for the manufacturing. All right. So the key takeaways for these indirect operating expenses, right, is easier to estimate by asking the quotation from the vendors. Okay, and also need to take notes, right? If let's say your business operate in a different region or country, right, you cannot expect the same pricing for the same country. For example, maybe the accounting fees in Malaysia is about 1,000 per month. Perhaps if you go to the Singapore, right, so it may be cost you about 1,500 or 1,600 after the translation. All right. So again, different region and different country, they always have a different price expectation. Okay. So this is a more towards the key takeaway for how you actually estimate the indirect operating expenses into your financial modeling. Okay. Okay, and also the next one, I think I would highlight in terms of the personnel expenses. Okay, again, personnel expenses, right, always can be very complicated because I'm not sure how's every entrepreneur here, but for me, personnel, is always very tough, to manage. But of course, personnel expenses is a different thing, okay. So the definition of a personnel expenses, right, refer to the remuneration that a company or business make to the workers under exchange, which go beyond the payment of salary. All right. So So in this section, right, so there are all kind of retribution and variable compensation and mandatory contribution to the different social security regimes. Also included are the social benefit that include all kind of pension and expenses of a social nature. All right. So again, personal expenses, why I want to cover, because I think just now I mentioned some of the personnel is classified under cost of goods sold, and some is actually classified, is the indirect operating expenses. Okay, for example, direct labor, they're actually more towards engaged with the production of a goods sold. So, and also in terms of this part, right? So it will actually classify under the cost of goods sold. So this is actually what I mentioned earlier. All right, sales and marketing. For the instance, sales manager, marketing manager, copywriter, social media expert, right? So this employee actually part of your operating expenses, which means the indirect operating expenses. Okay. The next one, IT. Some of the people, right, they actually recruit the R&D manager or software engineer or technicians, right? So where this person's salary classified into. So all this will be part under R&D. And I mentioned earlier, it will be classified under balance sheet. It shouldn't go to the P&L. It's only when come to your product, it start to have a commercialize of your product, right? So then you only will start to do the amortization. And also the next thing, how long in terms of the amortization period. So it depends on how long your product can be sustained. And also, and always is normally you have to justify to the auditors. And if they're okay, then they will allow you to do the amortization. So for the IT, I think generally is about 3 to 5 years. So it depends on what kind of the product you have. All right. So, and also the last one is the general and administration. So again, your back office or even your C-level personnel, such as CEO, CFO, CMO, secretaries, right, bookkeepers, all this is part under your operating expenses. All right. So I try to highlight this one. So you have a few different categories. So some is a PML top line, some is PNL after the GP, some is actually capitalized to the balance sheet. So at least I try to explain this is you all can have a very clear picture, even though it's a core personnel expenses, but because of the different explanation definitions, all is classified into the different components of your P&L or balance sheet. All right. So what is actually the key takeaway to estimate the personnel expenses? All right. So the first one is actually the current market salary trend. Okay. So what is actually the market salary trend right now? For example, if now the minimum wages is 1,002 or 1,005, right? But somehow in your forecast you still put a 1,000. So that means this is something is wrong. All right. And then the second, everyone is just know how to forecast in terms of the gross salary, but you don't forget you have the statutory payment. All right. So in Malaysia, you have an EPF, which is the employer contribution is 12%, and of course also and all this EIS, right, is less than 1%. All right. So then the third one, how about bonuses? I mean, you also have to do it into your forecast, into your financial modeling. Some people, they are not bothered this one, but come to the actual fact, they should have a bonuses. Some even, have an incentive, or even like nowadays, telecommunication is a fixed allowance and all these things. So just make sure that all these things is take into account when you prepare the financial modeling. All right. And also the fourth one, increment and promotion proposal. So basically, I think this one actually quite many people neglect on this part. All right. So because they may just assume that everyone just same salary, from year to year. All right. So you should have an increment and should have a promotion proposal as well. All right. And of course, the fifth one is your number of staff. Okay, because you see when you do the expansion, right, basically in terms of your organizational structure, you may change as well. Okay, last time you only have a 5%, you don't need a HR person. All right, you maybe also can outsource your finance, team. But when your company grow to like, let's say 30% or 50%, right, so definitely you must have your in-house finance or HR. All right, so all these number of staff and also the organization structure, right, you need to plan out. Because otherwise, right, you may actually unrealistically to estimate your financial modeling, and also it can actually affect your this valuation as well. Okay, so this is the 5 key takeaway for the personnel expenses. Okay, so I see got any new question posted or not? Okay, so far no question. Again, if you all have any question, you all can always put into the chat box, and then
Mm-mm.
Amira and myself may look into it lah. All right.
Mm-mm.
So if none, so I continue now. All right. Okay, so the next one is actually the capital expenditure. Again, financial modeling is also look quite critically in terms of this capital expenditure. But of course, it's not every business that require as well. But for example, like those are manufacturing or even like property developers or these things, right? Definitely they have a very heavy capital expenditure. Or even some of the IT, they have a new product, new IT product, right? So they may also have this capital expenditure as well. All right. So okay. So what are actually the capital expenditure? I mean, we normally call it capex. Okay. So this is actually the wording. Okay, combination of capital and expenditure. These two wording. So this capital expenditure refer to the funds that are used by a company, right, for the purchase, improvement, or maintenance of a long-term asset to improve the efficiency of capacity of the capacity of the company. So long-term assets are usually physical, fixed and non-consumable assets such as like property, equipment, infrastructure, and that have a useful life of more than one accounting period. Okay. So capital expenditure is also include the purchase of items like, for example, the new equipment, machinery, land, plant and building, warehouse, furniture and fixture, and business vehicle, software, or intangible asset. For example, like the patent or license, you also can put into the capital expenditure. All right. So the typical capital expenditure depends on the type of business, as mentioned, what kind of a business that you involve, and some maybe is not really require the heavy of a capex. Okay. So yeah, business and also industry. So for the startup, right? So I think it's quite common to invest in terms of the computer, software, office building, plant and machinery. Okay. So again, buying a building also applied as a capital expenditure. All right. So the key takeaway for this capital expenditure is first of all, you need to determine the asset useful life and also depreciation rate. All right. So if let's say you have a listing land, right? So basically you can base on the listing period, right? For example, some is 30 years. You can actually amortize it, over 30 years. All right. Okay, and then the second is your capacity consideration. Just now I mentioned if you are in the manufacturing or production line, so if you want to generate that kind of the revenue in terms of the quantity, so in terms of your machinery, you also have to consider in terms of your capacity. So then it can actually try to match to your financial modeling. Okay. And also the third one is when you actually buying a capex, right? So you also need to look at what kind of the type of financing you require, and also how much your cash flow impact. Because I believe just now one of the participants is mentioned, right, the depreciation. So P&L, when you go for depreciation, especially for 5 years, the P&L is always look good. All right. But somehow in terms of the cash flow, right? If let's say your this asset, right, you have to pay 100% cash flow, right? So it's 100% cash burn in the cash flow. All right. But of course, if let's say you want to use the financing, then again, you may need to do a borrowing, for example, 70%, but 30% maybe is still cash. All right. Then the 70%, what is the extra cost that you're going for is actually the finance cost. All right. So this is actually in terms of what kind of financing and what kind of the cash flow is actually important when you also have a capital expenditure. But of course, if you're only buying a laptop and all these things, right? So I think it's still fine because laptop is a few thousand, and also the depreciation rate is normally 3 years. Okay. And also the next one is the fourth one. There's one of the option is the capex and also leasing. Okay. So again, it depends on what kind of your business strategy and model. For example, if you are a startup business, right, normally I would not recommend you to buy an office or buy a building, right? So basically you can go for the leasing, okay? Or even some of your plant and machinery. If you still not stable, unstable, perhaps you can go for the leasing of your plant and machinery. So this is actually the option giving you to how to improve in terms of your financial modeling. All right, but of course, when you go for even like more stable, definitely you can always go for the capital expenditure because it's a more cheaper, and also some of the thing, right, is also when you have a more asset into your this fixed asset, right? So basically you have a more better financial position when you go for the debt financing or even the equity financing. Okay, so yeah, any question about the capital expenditure? Because I believe this is also one of the very hot topic, you know, when people want to see whether they want to invest the capex into the business or not. Any questions about the capex side? Okay, if no, then I will move to the next part. All right. Okay, so the next part is the financing and also the tax. Okay, finance, as I mentioned just now, if you go for some of the borrowing or some facilities, you definitely will incur the finance cost. So financing cost, also known as the cost of finance, is the cost, interest, and other charges involved in the borrowing of money to build or also purchase the asset. Okay, so this can range from the cost it takes to finance a mortgage on a factory, or to finance a car loan through a bank, or to finance commercial trade transaction of plant and machinery. Okay, so the key takeaway for the financing is three things. One is actually the interest rate. Second, tenure of financing, and also third is the type of financing. What type of the financing that you have? So maybe I can share some of the example. Okay, type of financing, you have a bank overdraft. Okay, so bank overdraft normally have a higher interest rate. Okay, but if you are doing more towards in terms of a trade business, right, or even like export, right, so you can actually have a trade financing, for example, like bank acceptance, letter of credit, you know. So all these things, interest rate will be more cheaper as compared to the OD. All right. So then the next one, I think we have a higher purchase. Okay, so higher purchase, the difference between a higher purchase and also the normally financing, right, is a HP is a more towards a fixed rate, and that means you compound it every year, same year. But somehow some of the loan, right, for example, term loan, they're actually using the reducing balance method. So that means whatever you pay the principal, they're only based on your principal to times the interest rate. All right. HP, for example, if you're going for, let's say, 5 years, let's say you have a HP of 100,000. So 100,000, you need to times the 5 years, and then you times the interest rate. So everyone have to be know that different type of financings, right, have a different interest rate. The interest rate for the HP, even though it's a 2.0%, if you have a longer tenure, it's actually even more high effective interest rate. But somehow some of the term loan, right, maybe have a 4 or 5%, but it's still cheaper than HP. All right, because it's a two different way of compute the interest rate. Okay, so these are the three items that you all have to determine when you all want to do the financing and also input into your financial modeling. All right. Okay, so the next thing is tax. So what is tax? I think everyone knows 24%. Malaysia, that's the max. I mean, of course, SME, they have a tier rate, you know, from 15%, then, you know, slowly convert to 24%. Okay, so corporate tax are collected by the government as a source of income. Okay, taxes are based on the taxable income after expenses have been deducted. Okay, maybe I try to explain what is called taxable income. Okay, in the P&L, normally you have the profit before tax. Okay, but somehow the profit before tax cannot be straight away to take it and then times the tax rate, then you will know how much the tax that you're going to pay for that particular year. Okay, so you need to get the calculation for the taxable income. For example, some of the items, right, may not be able to do the tax deduction. For example, secretarial fees. So secretarial fees, right, normally need to add back. Okay, so from the profit before tax, you need to add back secretarial fees, or maybe some of your the document do not have a proper supporting document, you have to add back. So then only you will become your taxable income, and then from there, then you will actually have a tax rate, and then that is how you actually calculate the tax. Okay, so again, corporate tax rate vary widely between a country, with some country considered to be have a tax haven due to their low rate. Okay, corporate tax can be lower by various deductions, government subsidies, capital allowances, and also unabsorbed losses. I think one popular case in our Malaysia, right? I think is between Malaysia and Singapore, because these two countries are very close to each other, right? So I think most of the Malaysians is also very normal that they have set up a company in this Singapore. Okay, so as I mentioned earlier, Malaysia have a 24%, but somehow Singapore is actually only 17%. So you can see the huge gap between the 24 and also the 17%. Okay, but again, you have to bear in mind that is the rules and regulation is called transfer pricing. So transfer pricing is basically this allows some of the tax benefit enjoyed by the owner. But of course, if you all have this kind of a situation or scenario, always can come to me. Okay, so I can give some advice in terms of the tax planning. All right. So the key takeaway for the tax, right, is only two. The first one is a tax rate, as I mentioned. What is a tax rate? Because some is a different tier. Indonesia is also a different tier of a chargeable income, and also different country. Okay, and then the second is a tax installment. So everyone, don't forget, perhaps you are just first set up, right? You don't need to pay any tax installment, but subsequently, I think after 1 year, you have to do the tax installment. All right, so the tax installment basically is like you need to estimate how much you earn for the next financial year. For example, now is 2024. If let's say I have a year end in this December 2024, right? So basically I have to start to pay installment from January onwards 2024. So I need to estimate how much the profit that I'm going to have in this 2024. For example, let's say 100,000. All right, 100,000. Then I calculate, my tier rate and all these things. Then after that, each month I have to pay the tax installment from January onwards. All right, so you have to estimate. But the only good thing is you can actually have a revision of the tax, right, in the month of 6 and also month of 9. So again, if let's say my financial year end is actually December 2024, I have one chance to do the tax revision in this June 2024 and also September. Okay, so the month 6 and month 9 is actually follow your financial year end cycle. Okay, if let's say your financial year end is March 25, right? So your first revision will be the September 24. Okay, so there's the rules and regulations. Okay, again, financial modeling for the tax is the two key takeaway: tax rate and also which country, and also the second one is the tax installment. All right, so this tax installment will actually impact to your cash flow. Okay, your cash flow projections. Okay, so the next one, fundings. Okay, fundings, a fundraising round may allow an investor to invest money into a growing company in exchange for the equity and also ownership. Okay, so the initial investment, also known as the seed funding, is followed by various rounds like Series A, B, and C. So again, new valuation is done at the time of each funding round. So again, this is a key takeaways because when you do financial modeling, you have to put the funding in. All right. So this funding in, right, you have to require how much you have your future obligation and also your expansion that you need it. Okay. The second, to fund your working capital, and the third one is actually to fund the capex. Okay. So this is basically your utilization of the proceed. Okay. And then the second is the cash flow. Cash flow able to highlight a company cash management, including how well it generates cash. Okay, so the main component of the cash flow statement are cash from three areas: operating activities, investing activity, and also the financing activities. Okay, so it's only three activities. Okay, operating, investing, financing. Okay, so the key takeaway for the cash flow is the income or expenses carry in both P&L and cash flow. The key distinction for both P&L and cash flow is timing. So I already mentioned earlier, so it's the timing. So you all have to plan in terms of the timing for this both P&L and cash flow. Okay, free cash flow is actually important for the valuations. Okay, because as I mentioned, normally startup company, they were using a discounted cash flow to generate the valuations. Okay. So far, no questions. All right. Okay, I carry on. Okay, number 7. So valuation. So the step-by-step process to determining the growth. After you have the financial modeling, so the next process we call it a valuation. Okay. Okay, so this step on the valuations. Okay. Again, valuation are important too in the fundraising in order to represent the value of the company investor seek to put their money in. Okay, so the key method of carrying out valuation is via discounted cash flow methods. As I mentioned, valuation, yes, they have a lot of a way to do it, but in terms of the startup business, right, normally we will use discounted cash flow method. All right. So the first one, create the financial projection for your company. So I believe this is the 1 hour plus that what I mentioned earlier, how you actually create your financial projection through your P&L and also your cash flow. All right. Then the next one is to determine the projected free cash flow, because you see when you have a 3 to 5 years, right, definitely you have a lot of free cash flow. Okay, that means it's a positive, because if let's say you're doing a business of a 3 to 5 years still negative, right, then something is wrong. All right. So this is actually why you're so confident with your business product, your business model, and how you actually, with the 3 to 5 years, this is how much you generate the projected free cash flow. And then from there, this is your second step. All right. Then the third step is actually determine the discount factor. Okay. Maybe I will try to use a very simple layman to explain what is discount factor. Excuse me. Okay, layman to explain what is discount factor. Okay, or anyone here can tell me what is the discount factor? Can everyone share to me? If you are shy, you can also put the typing in the chat box. Anyone know what is discount factor? Anyone want to try? Can raise up your hand. Okay, I think no one want to try this discount factor. Never mind, it's okay. Okay, discount factor is something like, okay, for example, 1 ringgit Malaysia. Do you think today the 1 ringgit Malaysia, right, is that the same worth as compared to the 20 years ago?
No.
Yeah, the answer is no. I think 1 ringgit right now you only can buy 10 sweet. I'm not sure whether can buy or not. Okay, so 1 ringgit last time, do you know how many sweet that you all can buy? In the past 20 years. All right. So this is actually the discount factor mentioned, because you see when you prepare the financial cash flow for the 3 to 5 years, right, you cannot expect the 5 years result or the figure that you all calculate, right, is actually same like what you you determine right now. Okay, so the value may actually be called it, depreciated. All right. So this is actually one of the reasons that you need to determine the discount factor into your discounted cash flow method. Okay, then come to the next step. Once you have the discount factor, you will calculate the net present value of your free cash flow and also terminal value by using the discount factor. Okay, and then the fifth one, you will sum up all result of step 4. Okay, then you can get your valuation. Okay. So what is actually the pros and cons of this discounted cash flow method? Okay, so the pro is good for early stage startup because you have a limited and no revenue. Okay, if for example, if people using a PE, right, to use your profit to determine your valuation, right, as I think just now mentioned, Razak, right, the profits maybe is only, let's say 10 ringgit, 20 ringgit. How to determine 10, 20? Even I give you the PE 20, right, you also get nothing. So this is actually, you cannot using just a PE, based on your PPT to calculate. All right. And also the second is value of firms on basis of future performance. So at least, even though I know it's a new business, it's only 3 to 5 years, but based on what I mentioned earlier, if you follow the proper step, to do the financial modeling, you still have some of the proof, to determine of your this valuation. Okay. And the third one, yeah, as I mentioned, you do not have historical. You cannot tell people, in the past, how good I am, because all these things may be the new market, the new product. Okay, so this is actually the pros for the discounted cash flow method. But of course, when it comes to the the disadvantage is no matter what, it's still a formula. Okay, it's just a formula. Okay, and also the quality of the valuations, right, it depends on heavily on the input variable, because as I mentioned earlier, when you put the quantity, you can sell 1,000, 2,000. Whether all this in terms of the quality, right? I mean, is that realistic or not? Okay, so I mean, this is a more, even you have some of the proof, you can get a quotation, but again, in terms of the execution part, for example, I can get a price quotation for the plant and machinery. Okay, for example, no issue. The figure is also realistic, but the problem is the execution. People say 1 month I can finish set up everything, but 3 months I may also not set up the production line. And because all this delay, right, will actually impact to the financial performance and of course your cash flow as well. All right. And also the third one depends on individual ability to create an accurate forecast of the business or not. Okay, this is also maybe like, for example, business model. Today, they may think this product is a good seller, okay, good selling. But somehow after 2 or 3 months or 6 months, they try, actually the sales is not really good. But somehow another product which may not so hot, but somehow is selling even better. Okay, so this is also depends on how the entrepreneur ability to whether you can more towards have a more accurate forecast, of the business or not. Okay, so this is actually the pro and cons. Okay. Okay, and also the next one, we call it a scenario and sanity check. Okay, this is more towards to check your reasonableness of the projection to boost the investor confidence or not. Okay, so again, entrepreneurs tends to be an optimistic people, which is a good characteristic to keep up the energy and push through where others might quit. Okay, this is a very good in terms of entrepreneur. But again, unfortunately, in many cases, the life of an entrepreneur tends to be a bit more disappointing in practice than it is on paper. Because as I mentioned, it sometimes is really not easy, especially in terms of the actual and practical. All right. So as I mentioned, then you can actually try to create a base case scenario, okay, and also try to create the worst case scenario by extend the runway, okay, and then after that you perform sanity check with a reasonable and also close to the realistic assumption. So this is the way how to minimize the impact. All right, I know entrepreneur is definitely optimistic, but again, when you prepare the financial modeling, sometimes you have to learn how to prepare the base case or even like worst case. Okay, so that you can know how you play around, between a very optimistic financial modeling and also the worst case. Okay, see how big the gap and difference. Okay, yeah. Okay, so sanity check. What is the sanity check? So this is actually an example of the common error. Okay, for example, a mismatch between the financial model and also the business plan. Okay, a financial model should resonate with the overall business strategy, because as I mentioned earlier, sometimes you may want to have this business model, but somehow it may not work, in a different kind of a perspective. For example, I'm doing this online travel agency. Okay, perhaps I know the Malaysia market very well. Okay, I know you through this one, the strategy you can have this kind of the achievement. But somehow, if you going to the Indonesia, all right, so maybe the different model you have to play differently. The strategy may also need to change. It's a very different. So as I mentioned, it also depends on region. It depends on the model. It depends on the business plan. So sometimes it's because of the mismatch, then it will create a lot of discrepancy between what is actually planned and what is the actual happening. Okay. The second one, over optimistic or very pessimistic revenue projection. Okay. So again, sometimes you cannot be too pessimistic again, because what we are doing the fundraising. If you are very pessimistic, right? So perhaps you have a very low revenue and also a very low profit. So with a low profit, for example, if you're doing a fundraising, right, the equity interest that you're giving out, right, is also a big portion. You know, you will diluted your major shareholders position in the company. Okay, so you may not over optimistic, but you're also not too pessimistic in terms of the revenue projection. Okay, so the next one, a funding need that is not adequately explained. So make sure you include a breakdown. Because as I say, you you want a 1 million, but somehow you cannot explain where you want to spend for. Because some people will say, oh, 1 million, I want to spend a 500,000, for marketing, but somehow they do not know what kind of them, because marketing also have a lot of channel. You have an advertisement, you have a brochure, you have a media, you have social media. So there's a lot of marketing channels that you can play with. All right. So this is one of the things that how you actually utilize the fundraising. Okay. Again, underlying assumptions that are not clearly defined. Yeah, as I mentioned, the proof whether you can support the numbers or not. As I say, one machinery, you can actually produce 100, but somehow your forecast is actually, you put a 500. So how can it, match with the description? Okay. Number 5, not enough employee as a part of personnel forecast, because as I mentioned, everyone want to do a financial modeling with a better forecast and projection. Somehow they actually forecast a very low employee. But again, with a low employee resources, right? Perhaps you can't do all the job. Even you have a very good sales, you can't deliver the product. Who actually will do the packing for you? Who will actually perform the services for you? So all this you need to consider whether the number of employee, right, is really can match what is your target revenue or not. All right. Revenue projection which are not aligned with the market size. Yeah, this one I think I explained earlier. Any operational expenses that are being left out, operational expenses which are misaligned with the forecast revenue. Okay, yeah. So I think these are actually the some of the common error here. Okay, yeah. Okay, so raising funds for your startup. So how to make yourself attractive for the investor? Okay, so yeah, maybe this is also a sharing session as well. Yeah, so can I just any one of you share to me, right? Actually, what is the fundraising? Do you think is that a help, or do you think it's a gratitude, or do you think it's a hope from an investor, or do you think this is a normal in the business transaction? Or do you think, yeah, I mean, it's a gift thing, from the investor. So actually, how you all actually look at in the fundraising perspective, yeah. Can anyone share with me how you all look at the fundraising perspective? Yeah, from an entrepreneur, yeah.
Sorry, Ivan, your question is how they look at fundraising, is it? What is fundraising to
How
them?
in terms of an entrepreneur, do you think it's a help, from an investor, or do you think it's a hope, or do you think this is a thank you? Yeah, you give me money, I want to say a thank you to you, or or do you think this is a helping assistant or what? Yeah, how look at it? How the entrepreneur look at it for the fundraising?
How do you look at fundraising?
Yeah.
If I can, Rashmi, if you can put in your input, what do you think? What is fundraising for you, especially as a new startup? Rashmi or Revan?
Anyone? If no one, then maybe Abira, you can try to answer this.
Fundraising, I mean, like, I'm not speaking from an entrepreneur's point of view,
Yeah.
but to me, I mean, like, fundraising, of course, whenever people put in money because they expect some return
Okay.
Okay,
All right.
so it's more of a, how do I say, like a profit for them as well. So it's a joint effort. Mm.
All right. Okay. Understand. Okay. Okay. I think Rasmi mentioned something. Fundraising is a raising fund. No, I mean how you look at the fundraising exercise. Do
Yeah.
you think it's a just a normal transaction or just a thank you because the investor pump in the money to your company, right? All right. Or do you think it's a help because I really no money? I hope the investor being a good people to pump in the money to my company and let me to run my show. So what kind of the yeah
Kind of
the
sentiment.
perspective that you look
Yeah.
at?
I think mostly a lot of the startups will look at it as the last one, Ivan, right? So they need
Mhm.
money, they need investors to help them.
Yep.
Yeah.
Yep. Correct. Correct. Okay. Okay. So, from my perspective, right, I think fundraising, as I think just now I agree with you, Amira, is actually the
Mm,
equal position. All right.
mm,
So it's not like something like help or what. It's like I have a dream. I have a confident business model that I want to go in for. All right. So if there's some of the investor that may have money, so it's
mm,
more towards in terms of a change. All right. I'm have a good business model, and this is my valuation. I hope the investor also look at my business model and they agree with me, and then we go together. All right.
mm,
So the compensation of the fund money pumping, right, is actually a change with the equity interest, which I'm
mm,
also give up my some of my equity interest. Okay. So for me, it's more towards doing together. But so it's not a hope. It's not because the hope it should be like you yourself entrepreneur. You should run for it because you are confident with your business model. All
mm,
right.
mm.
So this is only more towards the sharing session. Okay. Okay, I go to the next one. Debt financing. Okay, so other than equity, right? I mean, we definitely have a debt financing. Okay, financing via debt, and an example of financing via debt can be a loan which you receive from a bank, a business, or an individual, where you agree to specific terms regarding the payback and also interest. Okay, for startup, I think it can be difficult to receive a loan from a bank as they often do not meet the minimum criteria in terms of revenue generation and offering a collateral. Okay, I think based on my past experience, right, if you are not operate 3 years, right, basically it's a very difficult to get the loan from a bank. All
Mm.
right. But somehow, if let's say you have your personal wealth, that you have a lot of saving or money, with the bank or long relationship with the bank, maybe it can be a take an exceptional case because other than that, right, it will be very difficult if you based on the company capacity. Okay. So the advantage of using debt as a financing, right, is you can control of your company and with you and also your current shareholder. Because as mentioned, if you fundraising via the equity, right, so definitely you need to dilute your equity interest in the company. Okay. So interest on debt can be deducted from your tax. Okay. So that is from the tax perspective. Okay. That often has a discipline effect on management team and also resulting the cash flow are limited to the so the management will be encouraged to be more efficient and create value. Okay, what does this mean? If you're doing an equity fundraising, right, some people will say, 1 million straight away by me, but they do not have an obligation to repay the 1 million equity funding. All right, but that is different. When you come to the period, you have to pay the installment, which means you have to pay the installment. So no matter what, you and your management team, you must have a discipline because you know that if let's say you really fail to pay the installment, right? 1, 2, 3, you will go to the secret. 1 month, second month, third month, you can go to secret. When you go to secret, then a lot of things will happen. So this is actually the advantage of the debt financing. Okay. So the next one is actually the equity financing. So financing via equity, right, is an example of financing the funding you would raise from an angel investor or VC in return for share of your startup. Okay, for startup financing via equity is more common than debt financing because receiving a loan can be difficult. All right. So equity investor take more risk by investing money in a company in exchange for the shares, meaning that they could lose it all. since an equity interest investor become a shareholder, when she invests in your company, you will partly lose your control of the company as well. So moreover, you will need to share your profit with your new shareholder, and sometimes they might want to be actively involved in the management of your company as well. Okay, for example, like once you have this equity investor, right? So they also look at your dividends policy. So that means how much you generate the profit in that period and how much you're going to distribute. You know, some people will say, okay, I will take out the 10%, 20% of my profit to distribute as a dividend. All right. And also second part is some of the big investor, right, when they invest even more amount into the company, they may want to request for a board seat, for example, non-executive director, or even some that will say, I want to be an executive director, you know, I help you to look at, you know, marketing session and all these things. So this is maybe something that will, you know, discuss with you when they want to invest a big amount into your company. All right. So this is the equity financing. All right. So the next one is building your cap table. Okay. Okay. Actually, what is a cap table? I think cap table is definitely important. All right. Because a capitalization table, also known as a cap table, is a spreadsheet or table that show the equity capitalization for a company. So a capitalization table is most commonly utilized for a startup and early stage business, but all type of the company must use it as well. In general, the capitalization table is an intricate breakdown of a company's shareholder equity. So cap table often include all of a company's equity ownership capital, such as the common equity shares, preferred equity share, warrants, and also convertible equity. Okay, so again, if your company is only like one shareholder, two shareholder, cap table basically is very straight up because straightforward because you only have a paid up, you know, 1 ringgit and then how much. Okay, but somehow when you all do fundraising, right, it may not be limited to one round. It can be 2 rounds, 3 rounds, 4th round, 5th round. Okay, and each round of the fundraising, right, may have a different valuation. When you have a different valuation, right, that means the number of the shares, right, is also different. The pricing is also different. So a proper cap table should be maintained when you have this kind of a complicated, you know, fundraising exercise. And also some of the people, right, they also have a preference share as well, and some is even have a convertible equity. So cap table is really important because then you know how much of the equity interest you were diluted from time to time. And also when you go for the exit, you know, let's say for example you want to go for IPO, right, how much the share that you left, you know, for the IPO. So this is very important because even though sometimes when you less than 50%, right, which means you're also no longer in the control of the company as well. And the investor and the shareholders, right, they have the right to appoint another CEO to run the business. Okay, so this is actually what is cap table for, you know, and also try to record each of the transaction, how much their volume, how much their quantity, how many shares, how much the share, and also how much the equity interest of the owner or founders. All right. So the key takeaway for this cap table is, as mentioned, is showing the equity ownership capitalization for a company. So it's also essential for the financial decision involving equity ownership, market capitalization, and market value. So what we're talking about here is about more towards a financial roadmap. Okay, as I say, if you 1 round, 2 round, you're already less than 50%, right? You don't need to go for IPO already because you may actually lose the control, you know, before the VC. So again, all this financial roadmap is important, and it's good that you have a consultant to help you to plan for it, you know, when you go for the equity fundraising. Okay, capitalization table help private company maintain the calculation of their market value. So in the private market, they're also important for shareholder reporting and also new capital issuance marketing. All right. Okay, so the next one, why do startup need a cap table? So startup company generally have only a small number of equity owners. These often include the founders, friend and family of the founder. So and also the angel investor. So maybe I just share with you, we have some case, right? Because in terms of friend and family and founders, or even, friends and family of founders, right? Sometimes their contribution, right, may be only 500 600. So there's the long list, it's a 30-40%, right, to have this kind of fundraising. So as I say, the cap table is really important that, especially you have a long list of your investor. Okay, so keeping track of who own and what stake in the new company is important as it grow and raise capital from other sources, for example, like the venture capitalists, and also ultimately go to the public via IPO. Okay, so the cap table will be updated after each subsequent funding round, and also showing how ownership become diluted and also spread across the new owner as it grows. Okay, so company will constantly evolving. You have a lot of few round of fundraising, and therefore cap table must be continuously updated. Okay, not just do a first time and then you just leave it there. Okay, so I think it should be considered like quite last chapter. Okay, so there's a key consideration that you have to put into your mind. There's a 3 practical elements. Okay, the first one is actually the business model. All right, I will try to explain what is business model. Let's say, for example, I have a vacant land, for my business. Okay, so what is determines my worth of my land? All right. So some people that will say, okay, I will just change it, to the car park. Okay, then the car park, how many parking you have, how many parking income you have, that how to determine your valuation. Am I right? But again, if I have a different model to put in this vacant land, right, then I will say, I don't want to do a parking. Maybe I change it, right, to a small, let's say restaurant chain. I build a few shop, I attract some of the few restaurant, then the whole market value will be changed as well. You also remember the chicken, the fried chicken that I mentioned earlier point. So 3 of them also doing a fried chicken because of a different business model. That will be the different business valuation. So business model is very important for you. All right. And then the second, timing. So timing, what I mentioned earlier is you can always say 1 month I can set up production, 2nd month I can have my revenue in place. Okay. But somehow the timing will be actually the root cause for this one. For example, if your production line uses 6 months to set up, then all your revenue will be gone for the 5 months, the month 2 to month 6. So perhaps your revenue may only can start month 7 or even like month 8 because you still have to do a testing and commissioning. Okay, so timing is also very important that, it determines your valuation. Whatever you spell into your financial modeling, the timing should be also like quite close to realistic, or even not realistic. It's also try to close to the actual, because otherwise, right, it will really give you a big the headache in terms of the profit and also your valuation as well. Okay. So the third one is the deliverables. So deliverables means it's like whatever you plan into the picture, you must make sure that you're able to deliver. So you cannot just say something into your business model, but somehow if you cannot deliver, then it will be gone. So deliverables is also very important. As I say, the execution part, you can mention how well about your plan, but in terms of your execution, you see, sometimes it's an entrepreneur. Yes, you are good. You're good for planning. You have this what to say, the mindset, the brain. You have, it's very good. But you always have to remember, company is run by a team. Okay, in a team, right, you have a definitely different person. Okay, you have a tall person. You have someone is more plump. You have a more skinny. You have a more taller. So each team have a very different type. But the only thing is how you as an entrepreneur to try to give a motivation to the team, and how you guide the team, how you giving the job training to the team, right, to help you to deliver deliverables what you plan for. So this is very important. So again, don't always assume that everyone is same like you, know how to think, know how to work, you are so smart. So please bear in mind, definitely the whole thing is different. Okay, yeah. So these are actually the 3 items and key elements that I want to share with you in terms of financial modeling, and also how to convert your financial modeling into the actual. Okay, and also impact to your valuations. All right. Okay, I think that's all for my training. Any questions, everyone? Or no question? I think you're all very smart. First time I received no question. This is a smart team, I believe.
You guys, if you guys have any questions, no question, thumbs up.
Good, all this is a very all smart one.
Everyone also
I'm very impressed. Yeah, I'm looking forward for everyone, to successfully raise the funds. Yeah. Anyone, any questions?
Okay, Ivan, I think because I know
Okay.
this cohort is a mix. So some of them this is very new, some of them they're probably
Okay.
familiar. But either way, I think this masterclass definitely, I mean, like, you guys definitely gain a thing or two. If this is new for you, I know there's a lot of jargons, there's a lot of like new words that might be like a bit overwhelming. But if you guys are familiar, I'm sure this is like a recap so that you guys can remember again. If say, because Ivan is also our mentor, so if say you guys prefer a one-to-one discussion and then go through your cap table and then try to get Ivan to give you some advice or suggestion, then you can book his time as well. But do note that Ivan is very busy, so you guys will need to book him earlier. Or if you guys find it difficult, you can communicate through me as well. Okay, if you
Yeah.
guys have a business model ready and you guys want Ivan to help you with it, do let me know. So all of these things that Ivan have explained will be uploaded on the academy, on the platform. So the templates to the business model, the template to the cap table is also available there. If you want to do the exercise, of course, I would want you guys to do the exercise, but we know that we cannot force you. But do the exercise and then see, that's how you understand things better, right, Ivan? I mean, of course, you can learn so much from Ivan here through the class, but once you do it and you put it into exercise, then you understand better. Ivan, do you want to go through this one or no?
No, I think as I say, this is an example they can go and try if they want.
Yeah.
But
Yeah.
again, if they have any question, can go to you and then come to me. No issue.
Yeah. If you want to book a session with Ivan privately, okay? So maybe you guys are shy to ask. In Discord, the startups in Discord is very shy. They don't want to ask.
I think
But
it's not shy.
no worries. I
Yeah.
can book a session with Ivan. All right, guys. Thank you so much, startups. I'll
Okay.
see you.
Thank you, everyone. Hope you
Thank you,
guys
Ivan.
enjoy the session.